Hi everyone. Let's have a look at Eastman Technologies, their 2013 financial ratios. You can actually follow along in the textbook. As you know, on page 132, we have the statement of financial position for Eastman Technologies. And on 133, we have their statement of income. Okay, and then actually on page 135, it starts walking you through all of the ratios for Eastman Technologies. So on page 136, it starts talking about the liquidity ratios. And the first ratio that they talk about is the current ratio. Okay, so for the current ratio, as I mentioned, for modern industries, it's current assets divided by current liabilities. And the reason for this ratio is to see how easily their current assets can cover any current liabilities or debt that's going to be due in the near future. Okay, so their current assets, as you know, are assets that can be basically are turned over or easily converted into cash within a year. Most of them a lot quicker than that, right? Because we have our accounts receivable, which is due within 30 days. The one current asset that takes the longest to convert to cash is inventory. And that's why we use the quick ratio. So the current ratio is all of our current assets divided by all of our current liabilities to see how many times our current assets can cover our current liabilities. And in this case, the 600,000 divided by 445, it can cover it 1.3 times. So if all of our current assets were converted to cash and all of our current liabilities were be paid off, we could pay it off 1.35 times. That doesn't give us a lot of cushion. 2 times is definitely a better ratio. But if we look at the quick ratio now, which is our quick assets or our current assets minus inventory, because inventory takes so much longer to convert to cash, divide that by our current liabilities, and we can't even pay off all of our current liabilities. It's only 0.86 times, or not even once. Okay, so that could signal that the company may be in distress over cash. Okay, they need more cash in order to easily cover their current liabilities. So again, you can read up on this on page 136 and 137. Okay, and they say that for a quick ratio, a 1-to-1 ratio is acceptable. Okay, so moving on to the next one, which is our debt coverage ratios, we have our debt to total assets. Okay, so our total liabilities, which is our debt, divided by our total assets makes up 69%. So our total liabilities are 1,245,000 divided by our total assets, which are 1.8, and that's 69%. Or our total assets are covered with 69% debt. And of course, on the flip side of that, it would translate to 31% equity, because of course, debt plus your equity equals that of your total assets. Okay, so if we looked at the next one, which is our debt to equity ratio, total debt or total liabilities divided by total equity is 2.24 times. So our debt is 2.24 times that of our shareholders' equity. And again, you can read up on this in your textbook. It says that companies with a debt to equity ratio above 1 are probably relying too much or too heavily on debt. The next ratio is our times interest earned. And looking at the times interest earned tells us a little bit more about our debt, right? Because of course our debt causes interest charges or finance charges. So if we look at our profits before taxes or earnings before taxes, add back our interest charges. So in this case for Eastman Technologies, if you looked at your statement of income, it would be $195,000 plus $35,000, which would be our finance charges. And you add those together, divide that by the finance charges or interest charges of $35,000, and it's telling us that before we pay the interest, we have $230,000. Divide that by $35,000, and it's saying we can pay off our interest charges 6.57 times. And that's actually a great number of times, okay? So we luckily, even though our debt to equity ratio is high and our debt to total assets ratio is high, we seem to be very easily covering the interest charges that are being caused by our debt. Okay, so as I mentioned, we are not going to look at our fixed charges coverage ratio, but we are going to look at our asset management ratio. And our asset management ratio starts on page 142 if you want to follow along in your textbook. Okay, so looking at the average collection period. Okay, so what we need to do is find out our daily sales. And the way you find your daily sales is by taking your revenue for the entire year, which is your 2.5 million, divide that by your number of days in the year, which is your 365. So revenue divided by number of days in the year, so 2.5 million divided by 365 gives you average daily sales of $6,849. Okay, so yes, our daily sales, average daily sales is $6,849. And if you take our trade receivables from our statement of financial position, so it's telling us that our customers owe us $300,000, divide that by the average daily sales of $6,849, and it's saying that we have 44 days worth of sales outstanding. And most likely, just like most companies, Eastman Technologies does give a net 30 days to their customers. So the fact that they have 44 days outstanding is not very good. It sounds like they're having trouble collecting money from certain customers, at least. Next is our inventory turnover, which is our cost of sales of 1.9 million divided by our inventory from our statement of financial position, which is 218,000. So that's telling us that we have sold the inventory that we usually have on hand, which is 218,000. We've sold that 8.7 times, right? 218 goes into 1.9, 8.7 times. So that's actually looking like a very good ratio. But as I've mentioned before, the easiest and best way to know whether or not this is a good ratio is to compare it to something. Compare it to the inventory turnover ratio that Eastman Technologies had last year, or to a competitor, or even to industry standards. Then we look at our capital asset turnover ratio, which is our revenue divided by our capital assets or our non-current assets. And this helps us figure out how efficiently we are using those capital assets, right? Our equipment, our plant, our vehicles. How well are we using these long-term assets to generate revenue? And in Eastman Technologies' case, we are turning it over 2.1 times. And when we compare revenue to our total assets, it's 1.4 times. So of all of the assets that we have, which is 1.8 million, it's generating 1.4 times that amount in revenue, which is 2.5. Okay, so profitability ratios. So I mentioned as well that we're not going to use our profit margin on revenue. We are actually going to use return on revenue instead. And return on revenue, we use our profit for the year, which is our 97,500, divided by our revenue, which is 2.5 million. So it's telling us that our return on revenue is 3.9%. And if you go back and look at the vertical analysis for Eastman Technologies, you can see that it is also showing when you take profit for the year divided by revenue that it's 3.9%. We can also, instead of return on revenue, we can use it on total assets and also on equity. So of all of the assets that we are using in our organization, which is 1.8 million, the profit that it has generated after all of our expenses are paid is 97,500, which is a return on those total assets of 5.4%. And looking at our return on equity, so of all of the equity that the owners have and shareholders have built up in this organization, which is 555,000, the profit that that amount has generated is again the 90. Oh, they have a misprint here from your textbook. That should say 97,500, just like the two previous ratios. So 97,500 divided by our equity number of 555,000 says that our equity has created a return of 17.6%. Okay, so we can also create a couple of market value ratios. So our earnings per share would be the profit for the year, which is our 97,500, divided by the total number of shares that the company has. And the way we can find the number of shares is by looking at our information through the company. And usually it's on the statement of financial position, but it's not on Eastman's. But it is given to you in your textbook. Okay, so usually you can find this number right on your statement of financial position that's generated. So any real statement of financial positions, the number of shares outstanding would be on there. So the earnings per share in this case is $2.44, okay, $2.44. And then the price earnings ratio, which is our price per common share, so how much our common shares are trading for on the open market, which is $30, divided by your earnings per common share, which is $2.44, means that the price it's selling for divided by the earnings that it generated in that year is 12.3 times. And you can find this information about market value ratios, the earnings per share, and the price earnings ratio on page 150 in your textbook. Okay, hopefully this has helped, and I will be looking for your information if you have any questions. Thanks, everyone.